Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at Franklin Templeton's multi-manager high net worth portfolio. Now, this portfolio exists in 5 variations, going from conservative to aggressive, and we're going to look at the aggressive version, which effectively is primarily equities. So let's take this portfolio to Portfolio Analyzer and first have a quick look at the holdings. Now, what we do see, there's only 5 products in here. And although the names might suggest something different, all these 5 products are from companies owned by Franklin Templeton. And we can see the kind of like dominant exposure is simply large cap value and growth in the US and international growth. There's a tiny allocation to a bond fund with 5% and to a systematic premier product with also 5%. Now, from a portfolio perspective, so it's quite simple. So let's have a look in terms of how to benchmark this portfolio. And as you can see, the suggested benchmark is simply the MSCI World Index. And if you look at the performance since 2020, we can see that this kind of like multi-manager high net worth portfolio had almost the same performance as the MSCI World Index. Having said that, it slightly underperformed from a total return perspective, and we can also see that its Sharpe ratio was lower with 0.41 versus 0.44 for the MSCI World Index. Now, that's from a benchmarking perspective, and let's move on and see what has been driving the kind of risk and returns of this portfolio. Now, we run a returns-based factor exposure analysis, and what we should be seeing here is that, yeah, on an asset class level, it's primarily exposure to equities as expected, right? And over here, we do see the factor betas to popular equity factors. Having said that, we do see that the exposure to value, momentum, low vol, and quality and size has been all over the place. So from our perspective, there's no consistent style bias here, right? That the way the funds are selected, there's a little bit value in there, a little bit growth, but overall, it's not well, consistent approach is the wrong word, right? But you're mixing things, right? And so there is no kind of consistently positive or consistently negative exposure in this product. Now, what's also worth mentioning is that although there are these allocations to value and growth funds, from a risk perspective, it's almost all the risk can be explained simply by the stock market. So, of course, it's only a tiny allocation to a bond fund in here, right? But you can see the equity factors contributed almost nothing to the risk over the last 5 years. Now, that's from risk perspective. Let's move on to alpha. Now, overall, our regression analysis is an R squared of 0.95, which means we can explain the returns of this fund fairly well, or this portfolio to be precise. And if you look at the cumulative return contribution, we've seen the same picture from risk perspective that almost all of the risk and returns can be contributed to the US stock market in this case, and that the alpha was consistently negative. So that's not that great. Now, why is that? And that's relatively simple to explain. The problem with this portfolio is that it's quite expensive. The average or the fee on the portfolio level is 122 basis points. But effectively, you have a portfolio construction that is not so sensible. So what Franklin Templeton is doing here, it's combining funds, like for example, the large cap value fund and the large cap growth fund that have opposing factor exposures. So what you're getting is with large cap value, you're getting a positive exposure to the value factor, 0.61. But you're mitigating that with the growth fund. And you had the same thing for other factors, for example, on quality, negative 0.26, positive, negative, positive. So effectively what you end up is with a portfolio that has on portfolio level a very low, very low betas effectively to those factors, right? Because they're offsetting themselves, but you're paying high fees. And so overall, this is not a very sensible portfolio construction. It would be better to give the fund what a more distinct character in the sense of either you're value focused or growth focused, but not try to be both. The other aspect that's worth mentioning is, right, of course, this is an equity portfolio, so there's no diversification. Yeah, right. And then the kind of final question is, can this portfolio be simplified? And short answer is yes, because in this case, you can simply buy the benchmark, which would be the MSCI World index. We can see this actually would have outperformed this portfolio, and it would cost only 24 basis points versus 122. And this concludes our review of Franklin Templeton's multi-manager high net worth portfolio. So as you've seen, this is comprised of 5 funds, or 5 products to be precise. But effectively, there's too much factor offsetting going on. The products themselves are very expensive, and you can simply replicate that with the MSCI World. Hope that helps. Have a nice day.